Good morning, everybody, and welcome to the Iowa State University Dairy Team webinar. Today, our speaker is Dr. Larry Tranel, and he's going to talk to us about the difference between cash flow and profitability. Dr. Tranel grew up on a Wisconsin dairy farm, majored in ag economics and international studies with masters in ag industries, all from UW-Platteville. Tranel spent the next 10 years as dairy farm management specialist with UW Extension and the past 20 years with Iowa State University Extension as a dairy specialist. You will recognize his name with the development of his stress and grief programming, most recently here in Iowa. We're very pleased to have him today. A couple of chores. If you look in the chat room as we go through the program, I will put the short survey for this webinar, and then I will include where it will be archived. So we appreciate everybody spending time with us. Dr. Tranel, the podium is yours.
All right, appreciate that. So yeah, I enjoyed my time spent in Wisconsin too, as well as Iowa. I should update the resume. It's like, I think I'm in my 23rd year here now, so I need to update that. I do want to give credit to Dr. Kevin Bernhardt, a good friend and colleague of mine as well, for portions of the PowerPoint that we're going to see as well. So we're going to start on just with the big difference of cash flow and profitability. And what I tend to find is that there's just such a big misunderstanding from producers, from bankers, and just what the difference of these two things are. And so we're going to actually try to provide some detail on why one's important here and another one's it might be important there. So we realize that every farmer around manages their finances just a tad bit different. They actually think about their finances different as well. And one of the things about making dairies profitable, we always tend to have this thought process of minimalist thinking farmers versus optimalist thinking farmers. And that actually shows through in the profit records as well of how they think about it, operating profit margin versus asset turnover ratio, and just how they try to work with their profitability on their given farm. We also realize that in a lot of a senses that economics of dairy farming is not just about the profitability of the farm, but it's the quality of life as well. And there's a lot of things that come into play as farmers make what they think are profitability decisions, but the quality of life is a big piece of that picture as well. So what we're going to try to do today, these are the objectives, is how best to determine profit, try to determine what cash flow is and what it is not, how to analyze a dairy farm for profitability, and try to do some benchmarks of comparisons and why these top line profits that I call are very important. So the three that are starred there are probably the three that are my go-tos for determining profitability. Some people only use rate of return on assets, but I tend to find sometimes that cost of production is an extremely important piece of that. That kind of plays into that rate of return on assets, and also what people get out in the market for their labor as well, and that return to unpaid labor per hour. I like to try to skin it down that way as well, and then do some benchmarking with it. So the big three financial statements, I'm not going to spend too much time in here, but again, in order to do a profitability analysis, we undoubtedly need a beginning and an ending net worth statement. So I like to think of that as just a picture or a snapshot that you're going to take on January 1st each and every year. Last year's ending is this year's beginning. And so we have that picture, and then that picture you're going to see the number of cows, the number of acres, the tons of feed and things like that. And everything's got a dollar value attached to it as well. And so without that net worth statement done on January 1st, if that's your tax year from the 1st to the December 31st, it has to coincide with your tax year, because a lot of things can happen even in 2 weeks. If we have a tax year that starts on February 1st, but our net worth statement starts on January 1st. So those two really have to coincide. The second statement is a net farm income statement. This is kind of like a video camera that goes through the farm business from beginning to end. And in that video camera, you can see where incomes come in, expenses go out, a cow might die here. Okay, but all the events that happen that have a financial consequence on that farm or in that net farm income statement. And then the third one, which is kind of a wildcat in some respects, is a cash flow statement, because this thing mixes a lot of non-farm type stuff. It mixes investments versus expenses. And so it's got all sources and uses of cash, both farm and non-farm. Okay, so when we take a look at that whole thing about cash flow, it's just there's a big misunderstanding about its uses, and sometimes it gets way overused in making decisions, I tend to say, on farms. So when we manage dairy farm finances, we tend to say profitability. I put that as number one, because farms that tend to be more profitable tend to be more solvent over time. They tend to be better cash flowing farms over time, and they just tend to be, just financially healthier places for the farms themselves. So our goal is to cover costs and accumulate wealth. And I say less than 45, that tends to be a big goal for people that are under age 45. Solvency, as we avoid losses and wealth reduction over time. So once you get to a certain age, security tends to become more important. You don't really care to take as many risks. And then liquidity, again, there's that word cash flow. Now we need to be able to pay our bills on time, and it gets to be pretty important to pieces of it. And then we also work with a lot of farms that have psychological income, even sometimes as their primary goal, even above farm profits. Okay, so there's the quality of life. They do it because of what they love to do. And sometimes they'll forego profitability because their psychological income or the profit or the quality of life aspect of it. So bottom line, when we take a look at profitability, this is our equation. That profit is equal to price minus cost. We can either increase our price or decrease our cost, and thereby we're going to increase our operating profit margin down below. And or we can simply, with that same operating profit margin, you think of our larger dairy herds with more milk, more cows, they simply produce more. Okay, so they twist it on that piece of the equation. With that profit, you can think of return on assets. The price minus cost is our operating profit margin, and that volume is our asset turnover ratio. So how long does it take to gross enough income to pay for all the assets on the farm? That's our asset turnover ratio. The operating profit margin is basically every time you get paid $1 in milk sales or whatever, how many cents on the dollar do you save in a percentage wise toward your own family living after all expenses are gone. So when I do profitability, like I said, return on assets, because that's something that marries the net worth statement and the net farm income statement, very all inclusive. Okay, so if we're only going to go with one measure, that's the go-to. The milk production cost per hundredweight, I'm going to show some data actually from Wisconsin and some of the things that they've done, and just why the milk production costs are so important to profitability as well. And then the third one is return on unpaid labor. And as we go more and more towards labor efficiency in our operations, I tend to say that might be a go-to more so in the future, the more and more labor problems we tend to have on the farm. So those are the three go-tos that I would tend to say. And in any given farm, when I'm doing a data set and trying to say what farm is more profitable, sometimes the one with the lowest milk production per cost per cow might have a higher return on assets or less return of unpaid labor compared to another farm. And so sometimes it takes all three of these measures to say, yeah, this farm I think is more profitable than that farm. When we take a look at making decisions, I think it's pretty important for us to realize that making decisions on cash flow tends to be quite faulty for a lot of farms. So bankers really focus on cash flow and equity. So if something goes awry, they need the cash flow that's got to come from somewhere to pay those debts back, or they need to be able to take some equity to do it. So they're trained very well to do that. But again, it might not be always in the best interest of the profitability of the farm long term. So we also take a look at cash flow, the debt expense. Okay, I tend to say that's a misquote because your principal payment is actually in the cash flow. Okay, the interest expense is also in the net farm income, so it's in the cash flow as well. But that principal part needs to be thought of as an investment, not as an expense. Okay, the cash flow also includes some non-business factors, and it's not always a strong correlation to profitability. So again, we need to be cautious about using our cash flow as the main measure to determine if we're going to invest in something or not. So this is what a cash flow statement looks like. So you got your beginning cash balance, non-farm income, again, not related to the farm. Income taxes paid may or may not be farm related. The principal payments, you may have some from a personal, you might have some from the farm as well. Family living expenses, again, a non-farm expense. Your capital purchases, and this could be both farm because it could be a non-farm one as well. You might be investing in an IRA or something like that. capital sales, new money's coming in, and then the big one is the net farm cash income. So that one is heavily related to the farm, but the basic bottom line is that there's a lot of factors here with cash flow that really aren't even related to the farm, but the bills need to get paid back, and the bank really doesn't care where it comes from, if it comes from a spouse or it comes from the farm. So the other piece about cash flow is that a lot of times people, take a look at their Schedule F and say, well, I didn't make much money this year. So cash flow, or Schedule F, excuse me, doesn't always relate to profitability or cash flow one way or another, partly because of depreciation expense, especially if it's section 179, when you take a look where you can take depreciate a lot of things in a short order, sometimes 100% in that first year. So there's a few things on that Schedule F that really aren't very correlating to cash flow or profitability either. So why spend some time here? I need to move a cursor here. Hang on a second. Okay, when we take a look at why have a cash flow budget and spend time, I think there's three primary reasons to work with it. When we take a look at the cash flow itself, I'm having a hard time with my slides advancing here. Hang on a second. There we go. So during poor profitability times, we realize that cash flow needs to be the focus, okay, because it needs to get us on the other side of the crisis. And so any business goes through its peaks and troughs, its peaks and valleys. Okay, when you take a look at cash flow, the important part is during those negative times where things just aren't working out, is that we need some excess cash flow. It might come from someplace else, a new loan, maybe from some savings or someplace. Or our accounts payable might just build up, but that cash flow is pretty important to get us through the tough times. So the cash flow, again, does not equal the income statement because like it's scheduled with the depreciation, the inventory changes, accounts payable, accounts receivable, and things like that. But it does include those principal payments that we talked about, that again, it's an investment, not an expense, and all the cash payments we might use for capital assets and things like that. So things that should be depreciated out over years, but we're paying 100% of the cash for it right now. So there's a lot of things that are included and are not included with it. When we take a look at just the bottom line here, you can cash flow very nicely while going broke. So think of capital asset sales or accounts payable, that we can sell cull cows and just sell a lot of cows, and we can keep our cash flow positive, but at some point we're going to run out of cows. Okay, so we can kind of go broke as we can still manage to be able to cash flow. Again, I'm having a problem with advancing the slides. Okay, so it also does not equal an enterprise budget. Again, depreciation, opportunity cost of operator labor, opportunity cost of operator equity tend not to be on there. So when we take a look at budgeting, yeah, it's important for us to cash flow budget so we can figure out when those bad times are going to be, so we can try to work with it. But the cash flow budgeting definitely, I think, is an important piece of the puzzle. So here's a little illustration that Dr. Bernhardt put together that I thought was pretty cool for him to be able to do this in PowerPoint. Okay, so everything that goes into a cash flow. So it comes in from the farm operations, from capital assets sales, and again, they could be personal, they could be non-farm as well. Other non-farm sources like a spouse's non-farm income, loan proceeds, or something that might come from either Uncle Sam or another uncle you might have that gives you a little donation to the farm. So a lot of things that go into this. And then on the other side, we have these expenses. And so we have our operation expenses that come back out, capital asset purchases that are going to come out, especially we're going to pay cash for them and not incur the debt. Other non-farm expenses that might come in the way of IRA investments or just buying a personal vehicle or whatever, and then the debt service. So both the interest and the principal are part of that, and the cash flow will include those principal payments again, which are an investment. So if I'm showing negative cash flow, what do I do? Okay, so cash flow can't be negative. Those bills got to be paid. And so unless we're going to be going into bankruptcy or whatever, the cash flow can't be negative because we need to keep the business going. So let's have a couple of questions here. So if my cash flow budget is a positive $175,000, which means if all goes according to plan, I'll have a profitable year. So is that true or false? Everybody's on mute, so I'm just going to say maybe. So we don't know for sure, because even with a positive 175,000 in cash flow, that can go down pretty easy on a pretty good size dairy herd. So we realize that depreciation is a real cost that reflects the loss in value of a capital asset due to wear, tear, and obsolescence. However, it is a non-cash cost, so it should not be on the cash flow budget. Is that true or false? And that would be true. Okay, so we won't see it there. When we take a look at average dairy operating cost, here's just kind of a breakdown in a pie chart, and this is coming from some Wisconsin data, I think from the years 15 to 18. We take a look at purchase feed as being the highest one, and then followed by some of the hired labor. And so those are important pieces, and people really focus on the feed part of it, and they focus on the feed part of it, and they focus on the feed part of it, and thinking that's their way to reduce their cost of production. Okay, but I think there's some other things that come into play with it as well. So when we take a look at raised feed is not a part of this picture. At least it's not identified separately, but it is in the land rent, it is in the seed, it's in the fertilizer, it's in some of the machinery expenses and things like that. It's in some of the labor, it's in the depreciation. So all that raised feed might be going through a lot of those different expenses as well. And same thing with unpaid labor is a big cost often on a lot of farms, especially for those that don't hire a lot of labor, but that's not actually in these operating costs either. So when we take a look at total labor per hundredweight equivalent, on the axis on the bottom, and on the left side we've got our cost of production. We will actually see a very good correlation of total labor costs and cost of production. So labor efficiency, we realized in the last 5 to 10 years in the dairy industry, is extremely important, and I try to put it ahead of feed expense, even just because I kind of feel, and from the data that I see, it's definitely a very important one. Okay, if we take a look at feed purchased per hundredweight equivalent and look at their cost of production on the left, you'll notice that it's a lot smaller correlation compared to what the labor efficiency of the total labor cost is. Okay, so again, labor efficiency and feed costs both important, but if I'm going to put one ahead of the other, I'll probably put labor efficiency ahead of it at this point in the ballgame. When we take a look at different benchmark efficiencies, there's a lot of things we can take a look at on dairy herds. And so when we take a look at conventional herds here and hybrid grazing herds, which are grazing herds that take the best of the confinement world, and they also take the best of the grazing world and the Ameria system together. And then we have our organic herds and our organic herds that are no grain. When you take a look at labor efficiencies, 1.2 million pounds of milk sold, 1.2 million pounds of milk sold for the grazers, and these organic ones are actually much less labor efficient, but a lot of times they're growing a lot more feed. They might have 3, 4, or 5 acres per cow compared to these operations over here that might only have 1.5 acres per cow and buying a lot of the feeds as well. And you can see a big difference in milk production amongst the systems as well. And so when we talk about profitability, we need to be very cautious when we start comparing systems on profitability, and it's all got to come down again to that rate of return on assets and that cost of milk production, and also the return to labor per hour, to really compare those in an apples to apples approach. So when we take a look at big farms versus small farms, when you take a look at paid versus unpaid labor, renting land versus owning land, the interest charge versus an equity charge, so what we pay the bank versus what we pay us, those are all big factors in trying to determine profitability from the different farming systems, or from big farms to small farms. So just kind of want to throw that out just as a caution. When we take a look at the average of big farms and little farms, sometimes we'll take a look at right here where the larger farms, we're getting $37.58 per hour. The smaller farms only $31.85, and people would say right away, well, that means that the bigger farms are more labor efficient than the smaller farms. But if you take all that and divide it down per FTE labor, not just with what the owner's making, but break it down on all of it, we'll actually see that our smaller farms tend to be just as labor efficient. And in this case, in this data set, we're actually more efficient than the bigger farms, even though the labor earnings per hour were better for the owner operator. So when you take a look at the average, that the average was 23.31 for the average herd, 22.65 for the larger herds, and 24.85 for the smaller herds. So for the return to all the labor, the smaller herds were actually better. So again, we got to be careful when we start talking about labor efficiency and just this labor earnings per hour for the owner operator, or is it for the whole farm, to see which one's more efficient when we cross compare farms. So this is a slide that I've had with me for quite a few years, and I like to use it because we've got our conventional farms, we've got our grazing farms, we've got our organic farms, and we use this concept called net farm income, which I tend to say is a very misleading way to actually determine profitability. But I see study after study after study come out, and they're using the net farm income. Okay, there's a lot of things that happen. after the fact, after this net farm income. So here the 3-year average on these farms, the conventional herds at 624, the grazing herds at 672, and the organic herds at 859. So everybody says, well, these organic herds must be the most profitable ones because they have higher net farm income. And I tend to say that's probably not so, because we realize in the net farm income, the bigger herds probably paid more debt expense, and they probably have a lot more hired labor than the grazers or the organic herds, just suspecting. Okay, so when we take a look at 624, we could probably negate another $400, even $800 of monies that are already accounted for in this system that may not be accounted for in an organic herd that doesn't hire any labor and also doesn't have any debt. Okay, so even though it shows here that this one's more profitable, doesn't take too much to say that these are going to be a lot more profitable by the time we go through and do a full cost analysis. And so that's just one reason why I think when we do this thing, we can't use net farm income. You got to go through a full cost analysis to see what's really happening on these farms. So how come some farms make more money than others? Again, this is Wisconsin dairy farms from 2014 to 18. The lowest third are here, the highest third are here. When you take a look at the net farm income from operations, you will see a big difference in the net farm income from operations. You also see a big difference in the cost of production. So milk per cow only has a difference of 3.8% between the lowest third and the highest third. The debt per cow, we always talk about these high debt herds have high expense. We're going to have an equity charge whether they're paying the bank or they should be paying themselves. So the debt's more of a cash flow type thing problem. And the cost of production per hundredweight, there's a 15% difference. So again, cost of production tends to me, in my mind, to be the biggest driver of the difference in profitability on farms. When we take a look at the average cost per production, the highest 75th percentile cost of production at 1885, the average at 1686, the lowest 25% at 1508. So close to $3.80 some cents or 77 cents with that. So just a very high range in cost of production. And most of the studies that I do, whether it be organic, confinement, or grazing, I tend to find some very high variability in cost of production. This graph will kind of show in the red is the high 75th percentile of high cost of production. Here is the medium cost of production, and here the low cost of production. So this is the class 3 price of milk, and you can add another $1.50 or whatever onto this for whatever you're going to get for a mailbox milk price. But even the highest or lowest cost of production herds don't always cover what they're getting for a check in the mailbox. Here, if we put this on here with just a class 3 price, even the medium ones are barely covering the class 3 price. But again, we've got some money on top of that for premiums and what milk market they might be in. But the high cost of production ones, I would tend to say, even if I put that money on there, they very seldom do they actually meet the cost of production or get a milk price that would actually cover their full cost of production. So I think that's kind of where we're at in the dairy industry. And I think that's been going on for a lot of years. So how are profits created? So you can work your assets and you can turn your assets into gross revenue. You can also be efficient by turning that gross revenue, once you get it, into net income by really saving on your expenses. And the third way you can do is, once you have a profitability equation pretty well picked up, you can borrow some more money and use somebody else's money to grow your herd and do the same thing, but actually have higher volumes with it as well. So the first one is working your asset turnover ratio. And so basically it's how many years does it take to gross enough income to pay for all the assets on the farm? That's your ATO. So is it 3 years? Is it 5 years? 3 years is healthy. Sometimes I get into herds that are doing it in 2 years. I've got one right now that's even less than 2 years. Okay, so they might be having more rented assets versus owned assets and things like that. But it's definitely possible to have some pretty high ATOs. In addition, the operating profit margin, again, that's that price minus cost squeeze. We're going to be efficient here. We can either increase our price or decrease our cost, and that's going to be that piece of the puzzle. And we can try to do that as how much money we can save on the dollar for every dollar of income with us. And then this last one, again, is just kind of our debt to asset ratios, basically letting somebody else's money work for you in the operation. Okay, so the bottom line is this plays into this equation quite well with all things considered. So the top versus the low third return on assets on farms, you can kind of see in this graph of where they're at on return of assets. So again, a pretty good size difference, 7.6%. You can see the differences. And so it's not always the big farms that tend to have the highest profitability. Even everybody said, though, we hear a lot, get bigger, get out, economies of scale. I don't subscribe to that thought process very well at all. Maybe I should subscribe to it better than I do, but there's a lot of small farms that still are making a pretty darn good living milking cows. So when the price received by the top versus the low, in this low one, I put that note up there that realize that there's probably a lot of organic and grazing herds, and especially organic herds that might be getting $30 a hundredweight, which would actually take that average up. I can't say that for sure, but that's my gut feeling what's actually happening there. So a $2 difference there, but the other ones aren't quite so big as you take a look at the return on assets. But if we take a look at the additional revenue due to, I'm going to move something here, excuse me. Okay, so if it only take the price, even on these big herds, you can see that it's not that big of a variability based on just the price of what these herds are receiving in the top ones anyway. So when we take a look at the additional, for a second here. Okay, so the additional production by the top versus the low herds. And this is where I tend to say is that we focus so much on feed and we focus so much on production. And I tend to say we should be focusing more on cost of production and labor efficiency, but they're all pretty darn important for us to take a look at. When we take a look at the difference between these herds, again, there is definitely some significant difference on the herds, at least the 1640 and the 1711. When we take a look at additional revenue due to production differences with those larger herds, it definitely, when you start taking a look, even a little bit of a difference, and you multiply it by a lot of pounds and a lot of cows, that definitely plays into part, and that graph kind of shows that as well. So the cost of production of top versus low third return on asset farms, when we take a look at those costs of production, it is dramatic. Okay, so when you start taking a look at $3, $4, $5, $6 a hundredweight, even approaching $7 a hundredweight difference on the top versus the low, cost of production, I would tend to say, is the equation I truly want to work with on the farms. So when we take a look at additional revenue due to cost of production differences only, you can basically see what's happening here. And so I put a note in here that it's about $1,000 a cow when you start taking a look at some of these lower herds, if that's kind of the herd size. It's probably over $1,000 a cow. So I think that's pretty important about what's happening with this, that the cost of production differences is a major factor on the profitability of the farms. So with all that said, now I think the next step is that we realize that cost of production, labor efficiency, and a lot of these things are actually just the benchmarking are pretty darn important. So how are we going to do it? So we've got more than a few universities around the country that are using this dairy trans program to analyze the profits with it. So I'm just going to explain to them a little bit. What do you get is that simply we need a net worth statement at the beginning and the end. So last year's ending is this year's beginning. You use your Schedule F pretty much to get most of the cash flow type stuff and the net farm expenses. There's a few other cash flow items we'll need, and then basically just dividing it with the number of cows, the number of acres, and labor hours. And with that little input, we can get a pretty detailed scenario for an output. That'll actually do the net farm income, they'll do the cash flow statement, all your cost of production. There's about 80 different ratios in there for efficiency of resource use that really help us to analyze a farm business. So this is what the output's going to look like. You can do it for grazing herds. You can see up here, I can put high output confinement herds. We can put organic herds. I think there's about 4 sets of data in there for organic herds, different places in the country as well. So the producers' numbers are in blue here. It'll break it down on per hundredweight equivalent, per hundredweight of energy or corrected milk, dollar value of theirs per cow, and then kind of give a benchmark on a per cow basis as well. So all the incomes are going to take a look at. It'll be adjusted for inventory to give us the net farm income. And again, bottom line is that net cash income. I've said this a million times. I'll probably say it another million times before I retire as well. It's kind of like the end of the first quarter of a basketball game. You don't have a clue who's really going to win or lose. You don't have a clue yet if you made profit quite so much. We adjust it for inventory, and then we get our net farm income again, which is what a lot of universities and studies are using for a profitability factor that I think is a little bit erroneous. And just we need to be more patient and actually get down to a further analysis, but that's kind of like halftime score of the basketball game. game. We take out equity, whether the bank owns it or whether the owner owns it, that there's some equity charges that come out. And then we get to a return to labor. Okay, so we can still take a look at this, comparing our farm to our farm 1 year to the next. But if I'm going to take this and compare this farm to another farm, this is like the third quarter of a basketball game. I still don't know, does that go back over one person? Does that return have to go over 3 unpaid people? So I really don't know yet. So there definitely are a lot of things we need to think about as we take a look at trying to analyze the profitability on this farm. The expenses in the same way, we've got the dollar value of the producers, we got 100-weight equivalent, 100-weight equivalent benchmark, dollar value, and kind of benchmark on a dollar value as well. So it'll break it down onto the inventory, net farm income, equity, return to labor, and we already talked about just those still are not giving us full profitability type tools to work with. And when we take a look at, well, how do you take a look at some of these profits and take a look at cash versus inventory, but I think basically in the interest of time, I'm just going to go right here. So basically we have the income of 1850 on this herd. We have expenses of 1759. And in this expense, all the labor, all the equity, it's a total cost expense. It's a full cost analysis, and they still have 91 cents left over at the end of the year to take a look at it. Some people don't like that equity charge taken out, so we can do it without the equity charge. Some people don't like the labor, unpaid labor, or the equity taken out, so we can take that piece out of it, or we just take the labor out. So there's 4 different ways we can actually work with it, but the true way to look at it for your profitability on a farm is undoubtedly right here. So we'll also take a look at how efficient are they using labor in the operation? How efficient are they, on a per cow basis? How efficient are they on a per crop acre basis? And so when we take a look at doing that, you can basically take, this is again the producer's number, this is a goal, this is an average, and this is where they are between the goal and the average, for us to actually take a herd and try to analyze its profitability and actually kind of give it a ranking and see if they're more profitable than another farm as we take a look at it. So the 16 plus financial ratios. So we always said the sweet 16, but now there's some more ratios that we try to incorporate with this as well. But bottom line is I'm not a big cash flow guy. But basically we let that up to the banker to figure that out. But so once the I tend to say if it's a profitable operation, let's work with it. And then once it's profitable, then let's figure out how to get it to cash flow. But basically, I'm taking a look at the return on assets, and I'm taking a look at the operating profit margin, this asset turnover ratio. So here in this one, you see it takes 1.8 years to actually gross enough income to pay for all the assets on the farm. When you take a look at the operating profit margin, again, for every dollar they received, they got close to 10.5 cents of pure profit. I'd like to see this at a quarter, and we've got some that I've seen at 30 and 40 cents on the dollar, believe it or not, and they're not always organic, or they're not always grazing farms either. But those are the 3 measures that I would tend to take a look at. And if I really did a detailed analysis for a banker, I'd probably look at a few of these other ones as well. But again, this rate of return on assets of 5.75% times our operating profit margin at 10.42 times the volume ATO at 55.12. So we multiply these 2 numbers together, we get that 5.75%. So again, that's the number I want to get in people's mindset. That's the equation, I think, profitability wise, we want to get in people's mindsets. And then we'll kind of look at the profitability in this farm is actually in a status of pretty good to great, I would tend to say. So as we close up here, I just have a few questions. We talk a lot about robots. Okay, so the question, if a robot is profitable, then it will cash flow. Is that true or false? Any guesses? Okay, I would say possibly. We don't know for sure, and we always got to do more investigation. I would tend to say in the first 7 years it may not cash flow because you got to pay the bank back probably in 7 years, even though you're making a labor investment for 15 years. But from years 8 to 15, if that's what you have to do, then you don't have the bank payment anymore. So I would hope it would cash flow quite well in the last 7 to 8 years of its life. But then you might have some high repair bills and some other things that might come into it. So again, yeah, we really don't know if it's going to cash flow or not, even if it is profitable when we take a look at some partial budgets to look at the differences of what changes it made in the operation. So here's the profitability part of it. So in this analysis of this robot, I would tend to say that the financial impact, which is going to be the profitability, is a positive 1,472. But by the time you take a look at the difference in the capital recovery versus now paying this back in 7 years with the payment on the robot, some of the labor that was hired, there was not hired, was my own labor. Now I've got to pay cash for it because now I got to pay the robot to do it, but I wasn't paying myself previously. That total change in cash flow for the robot might be a negative 42,000, even though it's profitable, the cash flow. So again, I just use that as a closing example that profitability and cash flow are two different creatures that have two different purposes. And please don't ever use cash flow as a means to determine the profitability of a farm. So with that, I think I'll end it there. Does anybody have any comments or questions or anything else you want me to explain any further? But that's kind of the thought process.
Thank you very much, Larry. If we've got questions, we're a small group. Just go ahead and unmute yourself, and we would go ahead and try to make the questions answered. Remind everybody, if they'll look in their chat room, we've got the survey. You can click on it and help us out there, or copy the archive, and you'll be able to view this again at a later date. Do we have any questions from the audience? Okay, I've got one question just to, I guess, get it clear in my head. When we have a small herd that doesn't have a lot of borrowed money invested, they can be profitable, but still maybe not be able to make a living on the 40 cows. Did I understand that correctly?
Yeah, so when you take a look at small herds, yes, they need to cover family living. So even though they're profitable in as they are, and they might actually compare quite well, like on dollars return, like per cow or per labor unit per hour, things like that, but they just don't have enough cows to actually provide a family living nowadays. So, you know, back in the day when we could have family living at, I mean, I still remember when people were putting $15,000 and $20,000 in their family living in early parts of my career. And now there's a lot of families out there that think they're spending $50,000 or $60,000 a year. When you take a look at where the money goes, they might be spending $70,000 to $100,000 a year just on a family living. And so it really depends on what they need for family living. But yeah, they can still be very profitable at small herd sizes, but it might be a part-time gig.
If you could get one point that you wanted everybody to take home with them, what would that point be, Larry?
Probably that cash flow is way overused in determining the profitability decisions on a farm. And so I realize that a lot of our banking industry, they kind of need to protect themselves cash flow and equity. So that's kind of their go-to, but they're also giving a lot of advice to dairy farmers, you know, I think trying to maybe overprotect them, but again, realizing that farms that tend to be more profitable will tend to cash flow better in the long term, but that's not necessarily in the short term. So I just basically say is that cash flow is probably being overused in our profitability decisions. Okay,
final question. If you look at the example with the robot, that the first few years it's unlikely to cash flow. Is there another capital expenditure that has that same issue? I mean, if we put in a parlor or we put in an automatic feeding system, are we looking at similar issues?
Yeah, we tend to say that anytime you have a high cost expenditure, the difficulty of cash flowing, and again, I don't want to say that the robots don't cash flow. We've seen a lot of robots that actually cash flow quite nicely compared to what's actually happening now, especially those that are getting a lot higher milk production compared to what before. Okay, so I don't want to have that misconstrued there. But yeah, you take a look at a high cost parlor, I mean, that can definitely put a cash flow drain, especially if it doesn't increase labor efficiency. So if you're going to spend a lot of money, hopefully the money spent over time is going to come from someplace else that you have savings with labor, or things are just more efficient and things like that. So again, when you take a look at the whole concept of, as we invest in things, we just need to make sure that we're not investing just to save taxes that we're actually investing on these farms to make them more efficient.
Very good. Do we have any questions that just can't wait? Would like to entertain them now? Seeing none, Larry, thank you very much for your time and the great presentation. I think it really helped me begin to understand that cash flow and profitability difference there. Again, we thank the people for attending today and remind them that our next program, our next webinar is March 16th, where we'll have Gentry Sorensen talk about cover crops. Thank you.
Thank you. Take care.